I'll take that two ways. I'll talk about local debt going forward, long-term systemic effects, and then also what we're seeing today in the Chinese economy second. So from a local debt perspective, a lot of people ask, is the bubble going to pop? Well, the local debt is getting bigger and bigger and bigger, and it's a problem. And a lot of those assets are non-performing, and it's a real problem in China's economy. All different kinds of debt, including local debt. I'm not worried about it popping. Popping signifies sort of an acute crisis where China would have something similar to maybe what the West saw to some degree in 2008, where you'd have counterparties stop lending to each other and the economy freezes and you have this hard landing crash. That's not what we're expecting in China. I mean, I think that what we're looking at is more like a balloon that's letting out air over time. And the Chinese are going to have a harder and harder time paying off this non-performing debt. And that's going to take away from productive uses of the growth. And what it's going to lead to over time is a potentially stagnant economy unless they really get their act together and control this growth over the next several years. So from a long-term perspective, I'm not worried about the much feared hard landing per se. What I'm worried about is an economy that awash in debt that is stagnant over time and is barely growing a number of years from now. So I think that's the long-term perspective on this. The short-term, very interesting. What we're seeing in the first quarter is fascinating because it's way too early to call this deleveraging. We're talking about a few months. We're not talking about 3 quarters or 6 quarters or 9 quarters. But what we're seeing is a real change in the credit situation. This is just credit tightening in some sort of ambiguous sense. When we look at our SOE data, so what's happening at state firms, we're seeing the lowest borrowing levels for state firms borrowing that we've ever seen in the history of China Beige book data. So we had a decade of data. We have never seen state firms borrow less than they did in Q1. Large firms, which is an overlapping subset of state firms, but large firms are the lowest level we've seen borrowing in 5 years. The spread between what state firms are paying, what SOEs are paying versus what private firms are paying has just blown out in the first quarter. So I think, state firms are paying 10 something percent, and private firms are paying a little over 6%. And then you're seeing credit costs just go up across the board.
State firms are paying higher?
State firms are paying higher. Now, it's a little bit deceptive in that way because a lot of the time state firms don't pay back their loans. So this type of push, when government's hand is on the deleveraging, it's usually more towards privileging private firm access to capital and privileging their interest rate. There's only a limited amount you can actually make of what state firms are paying because, again, a lot of this debt never gets repaid. It gets rolled over and then it disappears into some black hole. But I think the interesting thing about what we're seeing then is that the privileged firms, the firms that are typically at the very front of the queue when it comes to accessing capital in China, are for the first time in our data very dramatically their credit access right now, and they're borrowing. So I think that this is a very interesting start to the year. It's one of the reasons why stocks have taken a U-turn because it's not just doing away with COVID stimulus. I think firms are seeing with the dynamics on the ground, the credit environment are much more difficult for traditionally privileged firms, and I think that that's scaring people a little bit. But it's interesting because, after years and years of not seeing deleveraging, despite many, many promises that deleveraging was happening, we were never expecting it. So to see this pop out in our data, I thought was very, very interesting for the first quarter. I think the answer is one, the recovery is very much underway. They feel at least partly confident in the way the recovery is going. But I think the other thing is there's obviously a great deal of worry about debt. When you talk to Chinese bankers or officials or people who are operating in China, they are usually a lot more considerate of the debt risk than the average Westerner who sort of has seen this machine work and has come to believe that that there's no upper limit on Chinese non-performing loans. I think that there's much more of a fear in China about what could go wrong. Who knows when, but it could go wrong. So what this means for us is Q2 is going to be phenomenally interesting from a credit perspective, because if this continues, it means they're really serious about pushing tighter credit policy, pushing a deleveraging, despite the fact that the recovery, while ongoing, is by no means set in stone. Which is why, if I had to guess, it's not going to happen for too long. But it is optimistic when it happens, and so we call it like we see it. Very little in Xi Jinping's time has been cutting down on the influence or power of SOEs. It's always been boosting them. So, the question is this something you see for 1 or 3 or 5 months and then it goes away forever? We'll see. But we did see it.